Welcome to CRE Newsroom. Today is Tuesday, 5th of May, 2026.
Yesterday, Amazon officially launched Amazon Supply Chain Services, ASCS, a move that signals a fundamental shift in how the company utilizes its massive infrastructure. For over 2 decades, Amazon has built one of the world's most sophisticated logistics networks, spanning hundreds of aircraft, over 80,000 trailers, and a vast web of fulfillment centers across the UK, Europe, and the US. Until now, this network was primarily a closed loop, serving Amazon's own retail operations and its marketplace sellers. By launching ASCS, Amazon is now stepping out as a standalone third-party logistics provider. They are essentially doing for the physical supply chain what AWS did for cloud computing, turning an internal capability into a massive external-facing service.
What ASCS offers? The new service provides an end-to-end logistics solution for any business, regardless of whether they sell on Amazon or not. The offering is divided into 3 core pillars. First, global freight. Access to Amazon's ocean, air, and ground transportation for moving raw materials and finished goods globally. Second, strategic distribution. Using Amazon's AI-driven forecasting to store inventory in bulk and position it closer to wherever the customer demand is. And third, last-mile fulfillment. A 7-day-a-week delivery service that promises 2 to 5-day delivery speeds for orders placed on a brand's own website or social media. The industry impact is already being felt. Several global giants have been named as the first users of the service, including Procter & Gamble, 3M, Lands' End, and American Eagle Outfitters. For these companies, the appeal lies in the ability to move goods from a factory floor to a customer's doorstep through a single integrated network. For the wider logistics industry, the arrival of such a dominant player as a direct competitor to traditional carriers like FedEx, UPS, and DHL represents a major disruption that will likely reshape supply chain dynamics for years to come.
Microsoft is expanding its London footprint in a way that matters beyond one deal. Taking the whole of Filmhouse, 142 Wardour Street, is a strong signal that major tech occupiers still want prime central London space, especially for AI-related growth. It also puts Microsoft in line with peers such as OpenAI and Anthropic, which have recently committed London office space, reinforcing the city's pull as a European AI hub. Microsoft has agreed to lease the entire 8-story Filmhouse in Soho, which is about 100,000 square feet. The building was bought by Heinz in 2023 and refurbished after serving as Nike's former London headquarters. The Times says the move gives Microsoft an extra London office line and highlights the capital's growing importance in tech and AI.
Before we move on to the next story, if you're finding this useful, please subscribe, like, and share this with someone else who follows the market. Your support really helps me continue producing these commercial real estate updates.
Claire's is set to return to UK high streets in June, with around 50 stores, according to The Guardian, after its last British shops closed only days earlier and more than 1,000 jobs were lost. The comeback is being led by Julien Jarjoura, who runs Claire's stores in several European countries and has approval from US owner Ames Watson to reopen the brand in the UK. Guardian report says Jarjoura is already negotiating new leases with UK landlords. He wants to reopen 4 to 10 stores a week, starting in June. The plan includes refreshed stores, continued ear-piercing services, and new jewelry and accessories. Existing concessions may be kept, but the Birmingham head office and old inventory are not part of the relaunch. This is a fast turnaround for a brand that only just exited the UK high street, and it suggests the label may be repositioned rather than simply restored. The report also signals that the relaunch is being treated as a new debt-free operation, rather than a continuation of the old UK business.
Barratt London has sold a 140-home build-to-rent scheme in Harrow to pan-European private equity investor LRC. The asset consists of 2 residential blocks within Eastman Village, Barratt London's wider regeneration project on the former Kodak site. In total, Eastman Village is expected to deliver around 2,200 homes, alongside retail, education, leisure, and other supporting amenities. LRC is a pan-European real estate private equity investor, and the transaction follows its recent financing deal with Investec for the acquisition of 3 residential assets in Hounslow, Surrey Quays, and Bedford. Those assets together comprise 293 homes. From a market perspective, the living sector remains one of the most active parts of the UK investment market, with several transactions completed in recent months. The deal also reflects continued appetite for well-located, income-producing residential assets, particularly within larger master plan schemes.
That's all for today's update. Thanks for watching, and I'll be back with more CRE and capital markets news in the next video.